Hey everyone, today's Wednesday, June 26th. The market just closed and we've closed at a new all-time record high. So that's great news, especially given how the year kind of unfolded. And yeah, I think the S&P and the NASDAQ are both up 4.4%, hitting new all-time record highs. And our core 20 portfolio, right? We went through this last video. That is 20 high quality stocks that we've now moved into our core portfolios, which are more endowment, fully diversified portfolios versus strategic, which is more aggressive and opportunistic. But core 20 is up 7.3%. That annualizes out to 6 percentage points about of outperformance on a yearly basis. And as we say, if you can beat the S&P 500 by 1 or 2% a year, you ought to be running your own money. So we're proud of that performance, but I think this is just the beginning for those stocks. We really like them. We've been in them a long time. So I'm looking at, I got a full whiteboard of notes here I'm going to go through, but yeah, the market is really exciting right now. I'm going to get to our new forecast, but I feel like I've been here before, you know, from the 1995 to 2000 bull market that we saw in technology where stocks were advancing 20% a year. I feel like we're right in that market. And I think we're kind of in 96, maybe in 1997, kind of on the early stages. I still think we have 3 more, certainly 2, but maybe 3 more years of this tech build out that we're seeing going on around the world, but primarily the US company stocks. So 3 years to go, and I do know what's coming, and it feels very similar. The difference is there were no earnings back then, and now you got companies like Microsoft and Meta and all these generating, Google, 20 billion every 3 months in profits, not revenue, profits. So this is real. And while stocks are now full again, they're probably justified, and we're going to get through all that in today's video. So yeah, let's get into this. Our 2025 playbook, we've said it a bunch of times, so I'll be brief. We expected an upwardly biased year, but we thought all the gains would be made in the second half of the year, and we're there now. June ends, the first half of the year ends on Monday. So we're there now, and we've had a massive correction that wiped out a lot of the froth, but we came into the year at 22 times earnings, okay? We crashed down, we wiped out a lot of the excesses. I felt really good about that, right? You know, we advised staying the course. We're now back at all-time highs. We're now at 23 times earnings. So the market is more fully valued than it was in January. The difference with this is that all of the excesses, all of the froth, all of the greed, it's been wiped out of the market in that crash we just saw 8 weeks ago. And now the market is still fearful. And as we said, if you panic out, you will not get in at lower prices. You're going to get sucked in at higher prices like this week because the news is finally good. And now that Iran, Israel, and the bombing that's behind us, the good news is finally starting to come out. So, so let's jump into why we're changing our forecast a little bit. So I want to start out with I have zero upside to saying this. I really shouldn't, but you know me. When I see something, I'm gonna tell you what I'm thinking. Over the past week or so, and particularly after the bombing in Iran that the U.S. did, I've become not mildly bullish on stocks, but very bullish. And I'm not talking about in the weeks or month ahead. I'm talking about over the next 1 year and 2 years. I mean, I think the landscape's great. Like I haven't felt this good about the market since 2019, and that was a really strong year. And we would go on 2019, we'd get through COVID at 2023, 2024, right? We really multiplied wealth. So yeah, I become very strong on that thing. Let's go through the reasons why. But first, the headwinds. There are some headwinds, and that is first on July 9th, just a couple of weeks away, we have the expiration of the pause in the reciprocal tariffs. And so if we don't get some trade deals between now and then, that could create some market softness. But we just heard today out of Washington that July 9th might not be such a hard deadline as they thought. I think the Trump administration is learning what the market likes and what it doesn't, and they can operate a little bit differently. And the market's beginning to wake up to that. We're also short-term overbought on our technicals, on the models we run. So, you know, I don't think it's anything really serious. We just get a little bit of a rollover and rebake in some oversold prices, and we can start buying again. And of course, there's always geopolitical stuff that could come up. It's a dangerous world, and that stuff can pop up. And, you know, if that happens, all bets are off. So, but you know, I want to be clear here on this bullish outlook. The valuations are full, okay? At 23 times next year's earnings, they are full. But I don't think a lot of analysts are looking at and a lot of people on you know, the financial news networks are not looking at these valuations correctly. And, you know, you look at a stock like Palantir, these guys on TV are missing that trade. Most people have missed it because it is trading really expensive. It trades at 600 times this year's earnings, which means nothing. The company's growing, you know, 50% a year. they are trading at 200 times next year. That's still really expensive, but the company's growing, average 35% a year, which means it's doubling more than shorter than every 3 years. So what you use in this case is something called the rule of 40, which is basically you take your earnings per share growth and you add it to your profit margin. And as long as the number's higher, if you're at 20% annual earnings per share growth and 20% profit margin or higher, you score 40, you can still buy that stock. And Palantir is no different than NVIDIA was when this was on its way up and we were making all this money in that stock. Basically, it was trading in the hundreds, 200s times earnings. Today it trades at 31 times earnings. It's at 155 today, new all-time high. It's sat forever between 100 and 140 over this year. It finally broke out this week, and it trades at only 31 times earnings. The market's trading at 23. The Microsofts, the Google, all these mature tech companies are trading at 30-ish times earnings, and I can't figure out why NVIDIA is only there. It's got a product that every single major tech company has said, the biggest companies in the world, Microsoft, Meta, Google, Tesla, they have basically said, each company alone has said, we will take every chip you can make this year and we will buy it ourselves. Oh, and by the way, the chips cost 40 grand a pop, okay? And they're making, tens of thousands, hundreds of thousands of these things. So I think Palantir easily ought to be trading at NVIDIA ought to be trading at 45 to 47 times earnings, and that puts the stock, today it's at 155, that puts it at 215. And we probably years ago put $2.5 million into NVIDIA. That stake today is worth $20 million, okay, for the 35 families we work with. So, and I'm not looking to, take profits in that thing anytime soon. I think this horse is just getting started. So we're looking at Palantir at overvalued. It's like looking at NVIDIA 4 years ago, and that was a position we put $1.5 million in several years ago, and today that is worth $18 or $19 million. Again, spread over a small number of wealthy families. So I don't think you can look at that. You take a company like Tesla, it's so misunderstood. Tesla, I have been in the story since 2013. I'm more excited about it now than I ever was. I have a $6 cost basis. It's at $335 a share roughly right now. And the analysts that avoid it just keep saying it's like a car company, and they're trying to compare it to Ford and GM. And if you're looking at Tesla like a car company, that's the same thing as looking at Amazon like just a seller of books, like how they started out. It's the same story repeating itself. $10,000 in Amazon in its IPO in 1997 is worth $20 million today. But you had to ride it up to the tech peak in 1999, and then the stock would crash 90% from there, from $7 a share to 30 cents a share. It IPO'd at 7 cents a share. Today it's worth $216 a share. It's a 70,000% increase. Again, 10 grand turned into 20 million if you could have held it for that entire time frame. You have to look at all of these companies and Amazon traded at 600 times earnings for like a decade. And all the profits were being plowed into a little thing they started called AWS, Amazon Web Services, which is now on its own one of the biggest companies in the world. So I think people are misjudging this market. They don't understand how to look at it. Not that we know everything and we make mistakes all the time, but I feel pretty good about where we are. Let's go through, so now I've gotten very positive over the next couple of years. We get through these short-term technicals in the next month, but let's go through the reasons why. Number one is cash. There is $7 trillion of cash sitting on the sidelines. About $1 trillion of it was raised in the crash a couple of weeks ago in that sell-off. Hedge funds had to liquidate down there due to margin calls. Individual investors got shaken out. And then as it kept going down, the hedge fund community got shorted, and all that money needs to come back into the market. So that's fuel for us going forward. Number two is, I've talked about it, but this huge build out in technology it's going to be going on for 20 years. It's literally the biggest thing I think the economy's ever seen in probably 100 years. And it's going to go on for 20 years. It's going to be in artificial intelligence, self-driving cars, robotics, cybersecurity, space exploration, which we have now begun to position heavily in. We own private shares here as a firm in SpaceX. It's one of our bigger holdings. And we own a mutual fund that every client has that has 10% of the fund in SpaceX shares, and Starlink, which is really a nice kicker. So we think this build out goes on for 20 years. It's going to be the macro theme. When you look back at the world 20 years from now, you're not going to remember what today was like. This will feel that archaic. So it's going to be pretty cool. Number three are interest rates and the Federal Reserve. As you know, we've been saying we think the Fed should be cutting rates now. We don't think there's any reason not to. Inflation is incredibly tame. with CPI at 2.5%, unemployment stable and 4%, 4.2% unemployment rate. The Fed's job is not to control the stock market or the economy. It is literally to keep price inflation in check, price stability, and full employment. Those are solved, okay? We may not be at the 2% target, but people don't remember that was set by Ben Bernanke in 2012 because we were in deflation after the financial crisis. He was trying to get up to 2%. We're normally 3 or 4. Ron Barron, someone we've been able to get to know and work with, he says inflation is always like 4 to 5% historically, if not a little bit higher. So anyway, let's keep moving on here. So we think the Fed should cut. We did get, the 2-year note is at 3.8% roughly, and the Fed funds rate is at 4.5%. They should not be inverted like that. So if they could cut 3 times is what I'm calling for. That's a 75 basis point cut. It gets us to 3.5%, 3.25%. That's a neutral rate, and I think the economy can really handle it. Plus, you got Trump barking at him to cut 2.5 to 3%. That's not going to happen, right? But he could just blame it on Trump if it doesn't work out for him. And after this, Powell's gone in May of next year. So in less than a year, Powell's gone, and whoever's put in, you better believe they're going to be crashing rates lower, and that's going to be very bullish for the market. It could even lead to some froth, but again, we're going to ride that market up. We'll know when to get out. We will know when to get to the whip, and we've done it before, and that's our job. So we keep moving on. Number 3 is the big, beautiful bill going on. It's now in the Senate. It's been tweaked. I hear they're ready to vote on it. We think that passes by July 4th. Let me tell you why I like that. It's really simple. There's tax cuts, a lot of money going to be around, and there's a lot of spending, deficit spending. The deficits will be a problem down the world, but we care about making money in the market, today. Here's the way I look at it. The world's biggest customer, the world's biggest consumer, the U.S. economy, is about to go on a spending spree. And we want to be on the other side of that thing, owning companies of the stuff those government funds are going to be buying, right? The best stocks we always own are usually where the customers are governments and militaries, where there are unlimited budgets. And that's what's going to be going on here. So we like that. Number 5, I was on a call this morning that Rick Reeder did. It was outstanding. He basically went through a dissertation on the private capital in the world is massive, over $450 to $500 trillion of private capital. A lot of it infused into the market after the financial crisis and after COVID. And then you've got all the public funds. They're all in debt, all the governments. So where do the private private people put their money? Well, you can't put it into the debt of these countries because the fiat currencies, the deficits are causing the fiat currencies to erode. And as the fiat currencies erode, you're going to lose the purchasing power of your money. So where does it go? It's going to go into the investment assets. It's going to go into stocks. It's going into bonds. It's going to go into collectibles, commodities, gold, Bitcoin, real estate, right? And there really are not enough assets available for all of that private wealth. So we are at high valuations. It's why they're justified. It's why you're going to probably keep seeing them. So let's sum this up. The year is playing out as we forecast. We had a rough first half. We're now through it. We're now going into the second half at all-time highs. I'm getting very bullish again, but valuations are frothy, and short-term, next few weeks, we could see a little curlback. Don't let it bother you. I reserve every right to be wrong because, it's a dangerous world out there and things can happen, and geopolitics can kick up at any point. And all bets are off if that happens, as you know. But I think post-Iran bombing by the U.S., as decisive as that strike was, I think most of the global players are going to be sitting on their hands a little bit. We're not experts in that field, but we do have clients that are international experts. And we talked to them this week, and they're saying, yeah, they feel pretty good about what happened and how the future landscape and geopolitics looks immediately. So let's keep our finger on that. I reserve every right to be wrong, right? So, but even though we're bullish again, like really bullish, like 2019 bullish, I won't be taking any more risk for clients or for myself. Although I'm at 85% equity, so right, I can't get a lot more bullish than that. We won't be taking more risk. We remain highly disciplined, highly consistent, and even though we're very, very positive, it doesn't mean we're increasing our allocation because we just can't afford if something comes up that causes markets to go the other way. So that's really it. I will be out next week for the July 4th week. Hope everyone has a safe and happy holiday week, and we will talk to you in the next video. If you have any questions, please don't hesitate to reach out to me or anyone on the team. Thanks very much and have a great night. 14. That's going to have to do it. I don't think I can do that again. I hope it recorded.